It's a few minutes after noon, and I always like to try to get started on time and end on time. Uh, but so thank you everyone for attending. This is our first Meet the Investor series of 2021. And this year we have a sponsor for the event, and that is Witherspoon Kelly. Rick Rep, are you on the phone? Apparently not, but Rick is one of the securities
I think he
attorneys.
is. Middle of the
I
screen
am.
here.
It just took me a moment to turn my mute off, but yes, I'm
Okay.
here. Thanks, Tom.
Well, I just wanted to thank you and thank Witherspoon for sponsoring this, and just kind of maybe give you the opportunity to say one or two things about the firm and your sponsorship of Meet the Investor.
Thanks, Tom. Yeah, I appreciate the opportunity. Witherspoon Kelly is a full service law firm that's been in this town for over 130 years now, and we've had the privilege of representing both established businesses as well as a number of startups here in the community. And we're privileged to be part of this program because we love what Ignite Northwest is doing and the great opportunities that are being created for new businesses and new jobs. And we're glad to support it.
Well, we're delighted to have you support it, and you and your firm have a very large market share in terms of working with emerging companies in the area. So it's been a great resource. Now, you haven't been with Witherspoon the whole 103 years, though, have you?
No, but I'm going on 20, so it feels like 100 years sometimes, 100 in dog years maybe.
Fantastic. So you're well experienced then.
Indeed.
Good. Well, today we have, we're featuring the SeaChange Fund. And on the phone, we have Will Finney, director. We also have his partner, Susan Preston, who started the firm, but I think Susan is deferring to Will today to give the presentation. But thank you both for joining us. Will has been with SeaChange and its predecessor for about 5 years. So a well-experienced VC and angel. Before that, though, he's got some real entrepreneurial experience, one with a company called Pivotal that had a very successful exit. And before that, he was a co-founder of a company that was in the mobile beverage e-commerce space that perhaps wasn't as successful as Pivotal, but nonetheless a good learning experience. Will is familiar with regions outside of the Seattle area because he attended both Carroll College in Helena, Montana, and Central Washington University in Ellensburg. So certainly not afraid to stray out of the Seattle Bellevue area. And SeaChange is actually one of the firms from the Seattle area that has invested in Spokane. Last year, they invested in MedCurity alongside with the Kickstart Fund and other members of the Seattle or the Spokane Angel Alliance. And I think in total, my Kickstart funds have now invested 3 times with SeaChange, most recently in Secure, which presented at our last Spokane Angel Alliance meeting. So delighted to have Will and Susan on the phone today. There's really quite a few similarities between Will and Susan's fund and the way that Kickstart is organized. But with that, I think I'm going to turn it over to Will. And I think really today's format is going to be an interview. I'm going to kind of ask Will a series of questions to kind of draw out what his firm's criteria is and how they differentiate themselves from other VC and angel firms. However, we want to make this interactive. So if you have a question, please kind of submit it to me in the chat, and then I'll queue it up and we can have questions during the presentation or the interview. And also we can have time at the end. So with that, I think we'll just really get started. First of all, I guess say, Will and Susan, is there anything about your background that I left out that you'd like to add in at this time?
I mean, Sue, feel free to jump in here, but I think one of the great assets that Sue brings to the table here is, she was by trade a corporate securities lawyer. After that, spent time on public and private boards and has been a venture investor for, I think, 20, 25 years now. So brings a real Rolodex and suite of tool sets that I think are hard at times to replicate, and they're nice for us to be able to keep in our back pocket.
Okay. Hey, Sue, what inspired you? What inspired you to leave your legal career and jump into this crazy world of angel and venture investing?
Oh gosh, I mean, there are so many countless reasons why you jumped the ship from being a lawyer. So those are a myriad of going most anywhere. No, it started back in 1999 when I started the first all women's angel investment group here in Seattle. And that just got me going on more involvement, more information, and the ability, and that led to working with Kauffman Foundation and so forth. I've got a very strange light coming in on me, apologies, through my window. It's sunshiny here.
Sunshine in Seattle is good.
It is. So it was really, I've just spent the last 20 years doing nothing but either angel or venture financing, written books, done all sorts of things, and have dedicated myself to this area because I find it fascinating, absolutely fascinating area, and one in which you can learn something every day, and it's quite exciting. And I think that we have a very good model that Will is going to talk about further that has shown really remarkable returns. All of our funds are on IRR basis, are in the top quartile.
Fantastic.
So we're doing great. And I really do give a lot of credit for our model that utilizes and leverages the intelligence of our investors, the crowd,
Yep.
and uses a very disciplined process that we've developed.
Okay, well, I want to hear more about your model, but well, first I kind of want to start off with some basic questions. What's your geographic focus? What industries do you focus on? What stage? How much do you invest? Do you lead investments? Kind of all of those typical screening questions that people on the call today will be interested in.
Absolutely. So kind of starting with the geography here, we are a regionally focused fund. We invest Washington, Oregon, Idaho, Montana. We have ability to do British Columbia, and then all the way up to Alaska. Although we haven't done any Alaska or Montana or even Idaho investments yet. From a focus, very agnostic. I would say, looking at the Seattle landscape and Bellevue landscape, a lot of what's coming out of here is either biopharma, medical device, traditional software SaaS companies. And so I think you see that reflected in our portfolio. Things that I'd say we're a little bit more skeptical on, and really just from a development point of view, is the crypto space, and then kind of VR and AR, wanting to see a bit more commoditization of those types of devices to make it a bit more appealing for investment. The fund in general will invest from pre-seed through A, targeting check sizes, 150,000 to 850,000. And we'll target 8 to 12 investments per fund. And then from whether we're leading or syndicating in, I think if it makes sense for us to lead, we will, and take a board seat, or we'll syndicate in if it's a great deal and we just would like to be a part of that.
Okay. Well, all of that is very familiar to me because both when I had my venture fund, Northwest Venture Associates, and now with my Kickstart Angel funds, my geographic focus being industry agnostic, that size range was all something that is very familiar and similar to what my approach is. And I think particularly when you have a smaller sandbox, having that agnostic industry approach really enables you to kind of see the best deals in every silo, so to speak. So I get it. What perhaps is more different is the structure of your fund. And it's different than, people are familiar with Voyager and Madrona and Flying Fish, but your fund is certainly different in structure. Can you describe that?
Yeah, absolutely. Breaking the mold here a little bit. When you think about a traditional GP-LP relationship, which is, as you spoke about, with Madrona or Voyager or Ignition, which is now Fuse with Kellen running it, You have the autonomy laying within the partnership to make their investment decisions. And sometimes they'll have a board that governs over them, and oftentimes they don't. And when the approach that we took, and I'll get to, the annual fund model, which again is probably closer to the Kickstart side there, is the ability for us to really leverage our LPs and our LP relationships into our diligence process, we think creates, this opportunity for more creative results. When you think about the GP surrounded by a bullpen of analysts, which often is, take someone like Madrona where there's, 70 people working there. You're the team that's supporting you, while, very well educated and well versed in what they do, they haven't owned necessarily their investments domain their entire life. And for us to be able to pull an LP that, has ML and AI background, or just using buzzwords here, right? But people who have really owned this their entire lives has been really great for us. We even place our LPs on our boards, which has been really helpful. What we like to think as driving value across the entire investment often starts at the board level. And for us to be able to place someone, again, relying on these domains has been really helpful for us. Going back to the model in and of itself, it is an annual model. So each year we're raising new financing. All that financing less a really small management fee is then put out into the ecosystem through somewhere between 8 and 12 investments, which we're targeting.
And my guess is you probably have a lot of the same investors kind of re-upping every year.
Yeah. I mean, churn is fairly low. That's certainly helped by the returns that we've been able to provide to date. But really, it's kind of this core group of 90 to 110 LPs that consistently invest with us. It's really great to get to know them more. They're often individuals that have a keen interest in being able to put their own skill sets to work, which is also fun to see. People that, again, going back to the domain, and I'll harp on this a lot, but, they want to be able to share their skill sets, leverage that, show, help the next, group of individuals really grow into, what their companies can and should be.
Yep.
May I interject just a really quick point there, Will?
Yeah, of course.
Really great discussion. I just want to also point out that of the new members that we get, the vast majority of them come from recommendations by existing investors. So our existing investors like our model enough that they're willing to refer us to their friends and family. So they obviously talk us up, and we get the most of our new members, new investors through that route.
Well, that's the best way to grow the fund. It's a flywheel effect.
Yes, it is. Yep.
So let's use an example. You invested in Spokane-based Medcurity.
Yep.
Chris Phillips is on the board. How did it come about that he was chosen to represent SeaChange in that investment?
Yeah, so I want to be able to say, hey, there's a ton of thought that really goes into this, but really there was, in the diligence process, Chris and the team really hit it off early on, and you want to keep those things intact as long as you can, right? If you build like really great rapport or affinity with someone, and you see them as a great place for sage advice or a safe place to be able to share things, I want to keep that intact. I don't want a company that's scared to come talk to me. I want someone that's going to bring me interesting challenges and have individual that's astute enough to handle those. Chris has a very storied background, has served on multiple boards, and really just came to be a pretty good fit. And even before we'd made the investment, we started having early conversations with Chris of, hey, if we do move forward with this, is that going to be something you're interested in? And you really make sure there's that healthy relationship that not only is the individual we're targeting to put on the board interested in doing it, but also that the team and CEO and C-suite's on board as well. And it just felt like the perfect marriage there. Sometimes it doesn't work that way. Sometimes you're like, I wonder who the right person is, and there's a bit more due diligence that needs to take place. But in MedCurities, that was one of the really easy ones for us. So quite a softball of a question, but maybe if you ask me the harder ones, I would say when you get into places where we may not have the germane expertise, but certainly have the ability to promote sales or business acumen at some level that elevates the group. You can start filing the Rolodex that we have of our investors into a good tiny cohort, and then you just start having individual conversations, and then maybe it's you have 2 or 3 candidates, and you just have the company meet with them. But usually someone will kind of self-promote, or not in a negative way, but really just elevate themselves in the conversation and say, hey, I really want this. And that's been really fun for us to actually do, because in part it allows Sue and I to stay completely focused on the fund, in the growing of the fund and the future of the fund, yet while still being intact. And I think, not to digress too much further here, but one of the things that we do that we think is unique is we bring in all of our board members on a quarterly basis in for what we call board roundtable. And it's this safe space that everything's confidential, but we can do lessons learned and share that way of, hey, like the XYZ company has this problem. Have you seen this elsewhere? And now that we have in aggregate, 8 to 10 different individuals that sit outside of the management on boards, it's been really helpful to internally share those, lessons learned.
Yep. Okay. Well, Chris has been an excellent value-added board member for MedCurities, so he was a good choice. Good choice.
Happy to hear that.
So one of the things that you talk about on your website about being kind of a differentiating characteristic of your fund structure is your timeliness. And you reference a couple of times that you strive to make investment decisions within 30 days. And that really is kind of a point that does stand out, because as anybody that's raised money from angel or venture funds before, they know how long the process can be. Totally. So, are you really able to kind of stick to that 30-day commitment? And if so, how are you able to do that?
So great question. And it's something we've been, internally trying to dial in and get better at. I would say a gross majority of our investments hit that. And it's really a testament to the process that we've put in place. It's a very structured process we run. And I think to take that even further, of the 30 days is often it's 30 days within getting in contact with the company. So when most people say it's like going into diligence, it's 30 days. It's really, we're striving for this 30 days from first contact to be able to give you some idea of yes or no. And if yes, here's what we're willing to participate at. So going back to kind of the root or heart of your question, I guess, was how are we able to do that? Again, we have this screening committee that allows us to kind of vet things at a kind of a different level, I think, than traditional firms are able to do, or angel groups. That gives us a higher level of conviction of once we've brought in the company. So I think there's a nice, hurdle there to allow us to kind of have a little bit of clairvoyancy in what it might look like if we were partnering with this company. And then the diligence process is kind of a ram and slam model of like, let's get this company through, let's throw all of our resources at it, and see what we can get out of this, and see if there's a path forward. And what I mean by that is, going back to being able to leverage the DD process, leverage the LPs, is I can assign individuals, hey, like I need you to go own this, or hey, like I think we need to focus here. And we have this first level of conversations of what are the risks and God, blank on the word, but what's like the risk that we have to making this investment go through, and then really focus on those and kind of flip the script of like, do I need to know everything about the company? Yes, to a certain degree, but what are the things that are really going to be the impasses in the things that are going to get us to a no, and let's focus on those first. And then, if we don't feel like there's huge financial risk for the company, like maybe let's put that off towards the end. Or, hey, like we're really comfortable with the management team. They've came in through a warm recommendation. Like I probably don't need to dig as much there. We'll get around to that. So in kind of the post-term sheet or post-commitment, we can kind of sort through those last things. But yeah, I mean, we've done investments in 10 days. We did Scener, which is a current portfolio company of ours that we invested out of this fund. That was 10 days from introduction to close on investment. That was super fast. Arguably stressed our model a little bit. But yeah, no, in general, 20, 30 days, I'd say is rather amenable for us.
Well, one of the things that often slows the investment process with angel and maybe some venture funds is the approval process. Some angel funds have to go out to all their members and get super majority or unanimous, and these angel investors could be anywhere in the world at the time the vote comes up. What's your approval process? Do you go out to your members, or are you and Susan able to kind of say yes or no collectively?
Yeah, so I want to be straightforward here. Sue and I don't hold the autonomy to make an investment. We hold the check writing ability, but that check writing ability is through a democratic process that's instilled in us through or given to us by the LP base. Towards the end of an investment, we put together what's called an investment memo. It's a very lengthy, self-generated content. It's not just regurgitation of what the companies have given us. It's really a thoughtful analytical piece of why we should be making the investment, and even, on top of that, what we see as risk to the investment. It allows people to think through that for themselves. Then after we send that out, we'll have an investment call. And so really, if you take, let's say, a 20-day investment period, those last 5 days are kind of running this process of the vote, as you so mentioned. And the investment call is, the whole DD team will jump on a call. Whoever from the LP group wants to jump on, usually there's 30, 40, 50 people on these calls.
Wow.
And it's, open season, right? Any questions, reasonable that, we need to be able to either defend or give some type of explanation for why we, wanted to move forward in light of XYZ. And that's worked really well for us. And I think it actually builds a higher level of trust, right? That it's not just this memo and kind of like blind pool investment of like, hey, like we say this and now it's going. It gives us really nice feedback loop of, hey, like maybe we missed something. And even if we do move forward, like let's go check on that. And that's been nice. So that leads directly into a survey monkey vote. I mean, it's nothing crazy. It's if we send out a vote out, we say, hey, we have a minimum participation value, which for us is about 75% of the fund. I think it's 75% of the fund that needs to participate in the vote. And usually we'll get those votes back within 24 to 36 hours.
Okay.
It would be, yeah.
Okay. Well, I mean, if you've got 30 or 40 people on a call to which you have to defend an investment thesis, that certainly incentivizes you to have done your homework and be able to respond. I can't imagine, I mean, I can only imagine the types of questions perhaps out of left field that you have to, you have to address.
You better believe it. I, in the early days, I didn't just have one boss. We had, 110 plus, right? So you're answerable to everyone. Going back to the model of why it exists is you do have this check, right?
Yeah.
It's not this unchecked balance to a GP writing a check. It's, hey, like, you better know your stuff. Otherwise, you're going to look strange sitting up there trying to recommend an investment.
Yep.
Fair amount
Being
of
able to make a
peer
decision that quickly is really a differentiating aspect.
Totally. And we hope so. We hope that it, incentivizes companies to come with us. This is competitive at the end of the day, right? Like a lot of people don't like to talk about that at times, but we're trying to compete against the other funds and often funds that are, have bigger brand cachet and names.
Yep.
And, our ability to work through a fast diligence process allows us to elevate ourselves, certainly.
Absolutely. So transitioning a bit here, how do you go about sourcing new investments? How do you find your opportunities? And specifically, let's go back to Spokane-based MedCurity. How did that come on your radar screen? And I know Amanda's on the phone here too. So Amanda, who's one of the co-founders of MedCurity, and I'd encourage her to jump in as well. But how do you source your deals? And
yeah, so let me focus on how we source it, and then I'll try in the back of my mind remember how we came into MedCurity.
Oh, I know. I remember.
Sue, I'm sure, will be able to help me here. I would say when you gave me the questions in advance and I had to kind of think about it and bucketize it, I think it kind of breaks it down to 60% comes from the management and generation by the management team. Peter, who's working with us now, who we brought on last year, has been really great. He and I've, really been able to grow this, network of individuals that really helps us and kind of provides this early stage deal flow. The other 20% comes from LP recommendations, which are always amazing, right? Getting your LPs involved and bringing companies, they have stake in the game, right? Like they don't want to waste your time. Those LP recommendations are really awesome for us. And then the other 20% are inbound. So I would say that wasn't necessarily the case in the early days, but it's starting to grow for us. And inbound for us is kind of this awkward stage of very cold outreach from companies of maybe not the right fit for us, but we can certainly help them or pass them to the right people. And then, every once in a while you get a high flyer and it's really interesting and you move forward with it. But if I were to take your question and extrapolate a little bit further, I would say 90% of our investments come from, or 95% of our investments come from, the management and LPI recommendations.
Okay. It's great to have that limited partner network because your limited partners are in many cases, successful executives or entrepreneurs themselves, and just have a great network.
Yeah.
We do have one question from Cervantes Lee about whether or not the CEOs of the companies that you're about to invest in are join the meeting at which that you're trying to get approval on a deal.
So interesting you bring that up. Recently, we tried it. In the case of, I'll use Senior, for example, Senior's deal had to be done in 10 days for us to be able to do it and lead the investment. And that prevented the ability to bring the company in for a pitch. And traditionally, we want our LP base to be able to see the company pitch, speak with the founder through kind of what we call our member meeting. And we weren't afforded that opportunity in Senior's case. So what we did was on the investment call, we brought them in for a light pitch, but then opened it up to gross questioning. I think we learned a lot from that. And it was an interesting way of doing it. But traditionally, to answer whoever asked that question, no, we don't. It's we like to be able to keep it internal, keep thoughts in a place that are safe, that if some of these questions that are more probing got out, it wouldn't reflect poorly on us, but we just would rather not engage with a founder at that discourse level.
That honest conversation amongst ourselves. But just to make sure that everybody understands is it would be an absolute rare. We've only had one circumstance in which the members, the investors have not been able to meet the company, ask them questions, interact with the companies. That is a must for us, either through the member meetings, monthly LP meetings, or as Will was describing, unique circumstances like with Senior. That's important for us, for them to kick the tires.
So the second part of my sourcing question was MedCurity, how that one came on your radar screen.
I'll defer to Sue here.
So this came
from who?
Through our office administrator.
Really?
Yeah, she went to college with one of the founders. So that's how it came through.
Wow.
And We got really excited when we saw what it was, even more excited knowing that it was in Spokane because we wanted an investment over there. And that was really how the process was for us. And we had just missed the close of their prior round. So we sort of did an interim with them, just with us, as a way of increasing the valuation a bit for them, but also getting the investment in that we wanted to have in the company.
Okay, I actually didn't know how that relationship came about. So thank you for highlighting that. We're halfway through the call, and I do kind of want to encourage anybody in attendance here. If you have a question, submit it to me, and we'll get it teed up. On your website, it says that you've made 41 investments or thereabouts, and you've had 5 exits. Could you kind of summarize some of your more notable investments and maybe a couple of your exits?
Sure, absolutely. We'll go back to Fund 4, which has been a pretty remarkable fund for us, and there's a couple companies that we can highlight there, but even I'll touch on a couple others as well. Prescriptive for us thus far is probably the closest company we could make as an analogous description to a unicorn. They haven't reached that space yet.
Prescriptive?
Prescriptive from a valuation perspective, but just what they're doing in the pharmacy benefits space, which is really democratizing the way that people interact with their scripts to actually drug delivery at a pharmacy level, and allowing interactions from the manufacturer directly to the end consumer has been really remarkable. We're really excited about them. It's hard to pick who your favorite children are, but they're certainly in the running. Kind of to show how agnostic we are here, Slumberkins, which is a CPG company based out of Portland, 2 really amazing female founders, Kaylee and Kelly, came to us with a company that was still in its infancy, but was based around social and emotional learning for young children. And it was a stuffed animal with these really amazing narratives around teaching these emotional skill sets. Another one
that's called Slumberkins.
It's called Slumberkins. Yeah, check them out. They just announced they're partnering with Jim Henson to have a series of streaming television for release sometime later this year and early 2022. And then obviously Secure, which you and I are in together, which is emergency savings. The statistic of 70% of America doesn't have more than $1,000 in their bank account is something we need to help fix and see where we can really dig in and help people. All tides rise all boats. This is something we can do to help, and it's a huge passion point for not only the fund. When you talk about double bottom line investing, this is pretty close to it with what Secure is doing. And then obviously Yesler, which was our most recent investment, timber marketplace. Yesler, which is a timber marketplace. Matt Myers, who was at Weyerhaeuser for about 30 years, running one of their large businesses there, left and started a timber marketplace, which is for everything from engineered hardwoods to lumber. And it was a spin out of PSL. Really excited about that one.
You'll have to get Yesler connected with Vaughan Timbers, which is based in Colville, right outside of Spokane.
Perfect.
I'm an investor in this company, and Vaughan Timbers is one of the leading national manufacturers of cross-laminated timbers, which is a new building material.
That is great. Let's connect offline. We'll get them set up.
We'll do that.
And
Well,
then,
those are a handful of compelling businesses. Now talk about some of your exits.
yeah, absolutely. So CSATs, which was kind of using Mechanical Turks to help grade surgeons. We had a really great exit through that to Johnson and Johnson a couple years ago.
Okay.
Build Pulse, which ended up exiting to Coppertree, which was doing a building management information system. So they were at Gonzaga. Actually, that was one of their first installations. So keeping it, in the Spokane area.
Yeah.
It allows for kind of antiquated or aged systems, which, the campus of Gonzaga isn't all brand new, of managing their internal, heating, cooling systems in part, matching that with like expected forecasts and weather patterns to make sure that they're efficiently using their heat and cooling and all of those internal capacities correctly.
Okay.
And then we had another portfolio company, which was a CPG company, where we had an internal stake buyout of that company, which yielded 21x for us, which was really awesome. Unfortunately, can't say the name,
Okay.
but yeah. So those are our
Good.
3 exits across 5 investments.
Okay. A related question: when you make an investment in an emerging company, what sort of return are you trying to model? And is that return calculated as a, IRR, or is it calculated as some sort of multiple? Of course, they're the same thing, just the inverse, but
Sure.
but I'm just kind of curious is what sort of return you're targeting and how do you phrase it?
Totally. So I think there's a couple different ways to skin this. One would be if it's a company that we have high conviction in that's going to exit quickly, I will forgo a large multiple for a higher IRR. Meaning, I can still, just given the numerator and denominator interaction there, I can still get a good IRR, and I'm targeting IRRs that are above 50. And the flip side to that is, backing into what I just said, which is 50% is, as I look at longer tails on investments of, 4 to 6 years, I need to be approaching, sometimes 7 to 10x on investments to get there. But then you have to take into account portfolio construction, which is, 80% of my investment should die, right? That's just general VC expectations.
Yep.
So I need the other 20% to provide me the yield to get me not only whole, but also provide a nice return for my investors. So, this 15 to 20x opportunity sets or 10 to 20x, I think become really appealing for us if we genuinely think they can get there. But, this is about getting on base. So I'm just as happy with that as well, going back to the short time frame. So I think venture investing is broken in chasing unicorns. I think you can have really great yield for your investors if you kind of play the sabermetrics of let's get on base a bunch of times.
Yep. I agree. I agree. So kind of based on your experience, if you had to kind of boil down kind of what are the 3 key criteria in your mind to success?
Totally. I think it comes down to 3 things. And when you put that question out there, I was like, man, what are those? And then I figured out rather quickly, it's founder market fit, it's product market fit, and it's a hungry leadership team. I want to see that the founder has some germane experience in what they're going after, that the product that they're trying to solve, that problem set for, is being accepted by the market, or that there's a willingness to interact with it, and that they're hungry and willing to do whatever it takes to get across the finish line. And I think when we see those 3 things, it makes it pretty easy for us, or at least creates a rather compelling story for us to get to a check.
Yep. So that was domain experience, product market fit, and a hungry team.
Yep.
How do you, entrepreneurs like salespeople, their pitches always look great, right? You know, if you invested just based on what a pitch deck looked like, you'd probably be making 50 investments a year.
Totally.
But so how do you discern if the entrepreneur and the team are really hungry? They're really going to show up. They're really tenacious. They're really going to have your interest at heart, and they're gonna make those hockey stick projections.
Totally. I think it starts at the diligence level and the first interactions that you have with a company. So for us, we have quite a lot of shots on target, I guess you could say, in interacting with a founder. So in the original diligence requests, in the interactions we have with them in those diligence meetings, all the way through to the actual decisions around investment, we're able to tell, like, are they getting it back to us timely? Like, are they valuing our time? Are they lagging on documents? A lot of times when we're looking at companies that we end up having pretty high conviction around, they've already got their data room put together, they're ready to go. So and within 24 hours of what we're when we've requested these documents. And the flip side to that is they're vetting us, right? Like, Slumberkins is a really great example of this. It's like they're being protective of their company. Like, I've built this, I'm very proud of it. Like, why should you be allowed to invest in this? And granted, they had a little bit different opportunity set in being able to hand choose their investors, but there is this really great dialogue that came of that. And you see that even when you don't have that similar dichotomy. And then the third I would say is, I think you can just tell a genuine passion when you meet it. Like, take our mutual investment Secure. When you meet Bassam and Devin, like, it just emanates from them. And it's that gut feeling of like, wow, like, the bee's knees of all things came together for them to make this happen. And it's just this gut feeling.
Yep.
So it's intangible.
It's more of an art than it is a science.
Totally.
Definitely. And one thing, I like what you said about, kind of how timely they are in returning documents and answering questions, because I often tell, entrepreneurs, people raising money, that frankly, how you answer a question is really more important to me than the answer to the question. And I could give a lot of examples, but just how they respond to things can give you some insight as to what they're going to be like as operators.
Absolutely.
There's another kind of transitioning here. From when I first started investing as a VC in the mid 90s to today, there's been a lot of kind of changes in definitions from pre-seed. We didn't even have pre-seed back then. There's pre-seed, there's seed, Series A. Back when I was investing with kind of Denny Weston and with Fluke Capital in the 90s, a seed round was maybe $1 million. But all of those metrics and the names have kind of changed. So for kind of the benefit of the people on the call here today, how do you kind of define what a seed or a pre-seed or a Series A in the current market environment?
Totally. I mean, talk about an industry where we chase fragmentation because it creates yield. This is so fragmented. The nomenclature is a huge issue in venture. A seed round in a Bay is different than a seed round in New York versus a seed round in Austin and Seattle, right? So I think when we start looking at these, it's a geographical reference. I would say even in Seattle, you could go pre-seed, seed 2, and then Series A if you wanted to be at a similar point to what a traditional Series A would be at in the Bay. But to break these down into like what I created as my own definitions is, I think pre-seed investments for us are like little to no revenue companies with a qualified idea, raising somewhere between 500,000 and $1.5 million, and usually on a convertible note. We typically aren't seeing price rounds in the pre-seed space. On the seed side, modest traction. we begin to get pretty interested around this 500,000 MRR, 600,000 ARR, and they're raising somewhere between 2 and 4 million. In A is strong traction, 2 to 4 million in ARR. In our mind, that's different in the Bay, certainly, and raising somewhere between 5 and 10 million. So that's how I personally would, articulate it. But I think if you asked, even someone at Madrona, potentially in Seattle, they would define it differently, which is,
Yeah,
again,
there's
this
lots of different answers to that question. It's still coming to gray area. We're starting to get quite a few questions from the audience
Sure.
here. So I'm gonna turn it over to some of the questions that were coming in. First up is Rick Rep. Rick, do you have a question?
Yes, thanks, Tom. So William, you mentioned that your investment thesis includes Oregon and Idaho, but you have not yet found any opportunities in Idaho. I'm curious if you've looked at any opportunities in Idaho yet.
We have.
If you can sort of give us some insight on, what different factors enter your consideration because of the geography.
Totally. And Rick, thanks for, sponsoring this first off. When we look at geographies outside of Seattle in general, or even Bellevue, I think we're looking for, in some cases, a value arbitrage. We're looking for really interesting places where founders have moved, especially in the pandemic, outside of, the Seattle Bellevue base, because they can live anywhere. And I think a great example of this, getting back to your Idaho question, is Boise. Boise is phenomenal. There's an incredible cybersecurity cohort of individuals there it's not Sabi, there's a big data center company there. And they've started to spin out a lot of really interesting companies. So going to, the heart of the question here of what are we looking for in geographies outside of Seattle is, I think there's an opportunity for us, given cost of living, to get in a little bit better valuation. I think valuations are a little bit more reasonable because of that. There's still really great tech talent, right? Like the ability for work from home is really democratized where you can live. You don't have to be in a tech hub to be able to be, part of a startup. A lot of our companies now, a lot of the employees have went elsewhere in the United States, which has been really nice to see. People, work-life balance is great. And then, I guess that's where I would start.
Perfect.
Hopefully that was helpful.
Chad Clay, you had a question.
Yeah, I was just wondering if we're ready to start the conversation, what would a package look like? What sort of information will you want ready to submit in addition to a pitch deck, financials? What all would you be looking for as part of that package?
Yeah, so just want to make sure I'm being clear here. The due diligence request being separate from the company request of like the pitch deck and so forth. Usually when I'm first meeting with the company, it's like pitch deck, maybe like a one-pager is like a prepper for myself before we have a meeting. And those can get us, a week into a conversation, or, through the infancy of the beginning of the relationship. When we do send out our due diligence request, and, I don't have this completely memorized exactly, but along the lines of, like the pro forma financials, advisory, go-to-market, competition, analysis that you've done, cap table, any customer contracts that you're able to share with us, and then, personal references in addition to customer references, if you have customers.
Will, do you have a list of some of that material on your website at all?
I don't know that it sits on our website. Potentially it does. I need to go look, but I can certainly forward it to you, Tom, and you're welcome to disseminate it.
Yeah.
Okay.
Yeah.
Good. Amanda, you had a question.
I just want to say that MedCurity is pleased, so honored to have the relationship with SeaChange. We've learned a lot through the process. They did have their due diligence process was very diligent. And we learned a lot through that process. So I just want to thank you for that opportunity. The feedback was frank and honest and thoughtful, which we really appreciated. So it was educational along the way. So so my question centers around metrics. You were talking about defining different, seed, round, series, and the different definitions. Metrics have the same thing I have found over the last few years. And so what metrics would you recommend that a startup company is gathering? I just think that, and then also as companies are posturing for growth and maybe for a Series A, or how does that evolve, and what would you recommend that they track? There's a lot of data we can track.
Yeah, absolutely. And sometimes, analysis paralysis too.
Yeah.
From it depends on every company. I think everyone's going to KPI themselves a little bit different way. From I was talking with an investment of ours senior this morning of like, I just didn't, frankly, I didn't know the KPIs to benchmark them. And so I wanted to have a conversation with them of like, how should we be looking at your domain, and how should we be, looking for some type of baseline to be able to measure you in the future. The obvious ones you can go to is kind of CAC to LTV, right? The normals here, cash burn relative to, your balance in your bank, right? Of just trying to better understand, hey, like how much cash are you burning on a basis forward? I'm trying to think what else. I mean, I think it differs so much for every company that I would almost flip the question and challenge the individual to tell me where they think I should be looking, and then let me go qualify and quantify that myself to make sure that, hey, this is great to see. Let me make sure this adds up.
Yeah, one of the good places to start with that, Amanda, is, we talked about a lot of the risks regarding company success and growth. And you can look at 4 or 5 that you want to track that over time, as those KPIs improve, the metrics that you have measuring for those KPIs improve. What you're doing is you're increasing the chance of long-term success and decreasing the chance of the company failing. So you can look at it from that standpoint. Does that mean that you want to make a consistent increase in pipeline? Does it mean that you want to show a decreasing time frame on close of deals, or conversion from demo to customer, which I know you have an absolutely blow away excellent record on that, by the way. Those are the kind of things. And then you can also, if the company's in R&D, software, what kind of development have they hit those toolkit requirements? How are they going out? Have they created any partnerships if there's a distribution required? So as Will was saying, it really is quite individual for each company. We just did this for one. I'm on the board for one of our companies, and we just did an exercise this week on that, which was a really good exercise to talk through with the board of what those KPIs should be. So I think the interactive conversation is really the best when you're trying to set those.
Thank you.
Good question. Good question. We have another question from Chris Malday, kind of on the LP side of the equation. Chris? Chris, you still with us?
Yeah, sorry. I'm hopefully you can hear me now. Yeah, thank you for the time. It's been super interesting. And I just wanted to flip and look at the other side of the equation. And I know that having a solid base of LPs is a great competitive advantage, and you guys seem to be taking full advantage of that. I'm just curious, as you go from one fund to the next, as you bring people in who might be more interested in joining, and you maybe have LPs that are being less constructive to the success of a fund. I'm just curious how you manage that, or how you've managed that as time has gone on.
Yeah, it's a great question. I think people self-select many times, and I think I know what you're getting at here of, what happens if you run into some difficult LPs or kind of voiceful LPs in a fund like this, or at least the way we have it structured. There's management mechanisms that we can employ to be able to, get the best out of the individuals that we need. And I think individuals that are less constructive, we can, I wouldn't say pressure, but we can challenge them to be a better person, or a more active participant in a sense of being a detractor in that sense. And there's tools that we can use, I guess, without going too far there. But the difficulty, I think, for Sue and I in general in this has been, we want to be able to keep meaningful relationships with all of our LPs. And so we've kind of artificially put in a cap. I mean, our cap relative to SEC is 200, and we've kind of put this artificial cap in at 120, and not for lack of interest in the fund, but really, there's something I read of, like, you can only hold like 60 or 70 meaningful relationships with individuals in your life. And being able to make sure that I can, have a conversation with one of my LPs and catch up with them as if they're a friend is, something I want to have. And I think makes them feel like they're at home when they're, committing their capital to us. So I think that's more of the way I approach it here. Is like, if I don't feel like I have that meaningful relationship, or what have you, then maybe they're better for a passive investment vehicle that we have, or something like that.
Huh. Very interesting. You cap it at 120.
We do.
Interesting. Well, we only have a few more minutes here, and as usual, I never have time for all my questions, but I would like to ask one more. And then that kind of relates to the market environment we're in right now. There's all sorts of IPOs, valuations are high. We've got things called SPAC. We've got Robinhood. Is this, I know you were probably only in grade school at the time, but I know Susan remembers, is this 2000 all over again? And if so, how do you advise maybe both your LPs to be patient, or how do you advise the companies that might be raising capital right now?
Yeah, so just to hit on the macro question here, I think, it'd be great. I wish I had a crystal ball, right? But in general, I feel like valuations are stretched. You're looking at 32 times PE in the stock market. That feels frothy. Yeah. But a lot of this, I think, comes back to, and where I find some, I guess, comfort in a way, is I'll think of a lot of this is driven by stimulus and Fed policy. And individuals are chasing yield, which then in turn drives up asset prices. And I don't, having read what I've been able to from a historical perspective about the late 90s and early 2000s, I feel like while there is frothiness, there isn't that uncontrolled investment into companies that have nothing. And while you certainly can bring up the SPAC thing, and I think that's in and of itself a conversation, you need to do your diligence on the types of SPACs you're investing in. I've done some SPAC trading. In general, I feel comfortable with the companies we're investing in, because at the end of the day, I can always say no to evaluation. And I think LPs should trust their fund managers to properly diligence the opportunity, that if something feels rich or out of place, don't do the deal, right? Like, there's always another deal. You don't have to force something. So I personally take, some comfort in that from an LP, and, I'm an LP in a fund. The flip side of this equation would be, can I get better rate in the market, or can I get better rate in VC? And I think that conversation will change over a period of, a couple months here, as you look at, I think, the stock market probably taking a little bit slower trajectory, and not trying to self-deal here and saying, I think venture provides a great opportunity, but I think venture in general has outperformed the stock market over time. Not even I think it has. I think 15% IRRs per year is pretty solid. So yeah, I mean, I think venture is always a great opportunity for individuals to commit capital to in down markets like we just had, albeit briefly and arguably with this K-shaped recovery. There's different ways people experience what's going on, but I still think there's a lot of great opportunity for companies.
Yep. None of us has a crystal ball, so it's good just to kind of invest consistently year in and year out. I was struck yesterday. I watched an interview on CNBC with Mark Cuban, and it was fascinating, because Mark said I don't look at PEs. Those don't make any sense. He goes, it's just all about supply and demand. And, you know, I certainly didn't subscribe to what he was saying, but it was a fascinating interview. And I forgot the name of the person that was interviewing him on CNBC, but that individual was also kind of just surprised by the flipness with which Mark kind of just claimed that traditional fundamental KPIs on investing no longer made sense. But we'll see
Totally.
where all this goes.
Yeah, one more. Yeah, it'll be interesting.
Yep. Well, we're after 1 o'clock, so I want to conclude, but really thank you for joining us today. And if anybody wants to get a hold of you or Susan, what's the best way to do so?
Will at SeaChange.fund or Susan at SeaChange.fund. You can also look on our website, SeaChange.fund, and our emails are there. So feel free to reach out early and often. We're happy to take the conversations or help connect you with the individuals that might make sense.
Okay. And my guess is, you know, it's okay for companies or founders to reach out to you even before they're actually fundraising.
Totally.
I found that to be a useful tool, both for the companies and for the investors to kind of get to know each other before actually having to make an investment decision. And a founder can kind of help determine which firm might be the best fit, and the investor has a chance to kind of get to know them in kind of a less stress-free environment where there's not a gun to your head to make a decision.
Oh yeah, I absolutely appreciate when companies reach out early. It it goes back to them doing their own diligence on you. It's I always appreciate that.
Yep. So thank you, and thanks for everybody in attendance. And just a couple of reminders. Next week on February 11th, we've got Scott Svensson, founder of Mod Pizza, lined up. So that will be a great conversation. And also, I believe on February 18th, we have the Ignite 25+5 that's being put on in conjunction with the Spokane Journal Business. So a couple of upcoming events. And then lastly, thanks to Rick Rupp and Witherspoon Kelly for sponsoring this.
Thanks, Tom, for your time, and thanks, Rick.
Excellent.
And Cindy.
Thanks, everybody. And thank you, Susan, for joining today as well.
Of course. Thank you.
Goodbye, all.
Bye.